Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. A few years ago, the buy now, pay later sector emerged as the hot new thing in financial services. It allows consumers to buy and obtain goods and services in-store or online immediately, but pay through installments over time without paying interest. Share market valuations of buy now, pay later companies soared, with the high watermark perhaps reached when US payments company Square, now known as Block, struck a US $29 billion all-stock deal to buy Australia's Afterpay in 2021. However, things are not going so well for the sector at the moment, with several companies flailing or actually even failing. To discuss the rise and fall, or at least decline, of the buy now, pay later sector, I'm joined by Grant Halverson. Grant, who is based in Melbourne, is the CEO of McLean Roach, a specialist retail banking and payments consultancy, and he's a long-time buy now, pay later skeptic. Hi, Grant, and welcome to the Of Interest podcast.
Hi, good to be with you.
Look, to begin with, can you just tell us a little bit about yourself, your background, what you do, and I guess what sort of clients McLean Roach works with?
Sure, no, happy to do that. Look, I'm a Kiwi. I started my career with LD Nathans in Auckland, had a period overseas working in the UK for a couple of manufacturers, then came back to New Zealand, and that's where my banking career started with NZI Bank, which of course no longer exists. But my first role was running the merchant acquiring business, and from there I actually ended up being the general manager of consumer banking, which had a whole range of products, including Diners Club, Visa, very high interest credit, also unit trusts, and 3 buy now, pay later programs. So this was in the 80s. So that's why I guess I've got some scars to prove what happens with buy now, pay later. I then went to Australia in 1988 was headhunted to run Diners Club for Rupert Murdoch and News Corporation. I went to Citibank in early 2000s, left there and did some consulting. And my last CEO role was actually for another New Zealand company called PFG Group, which had pioneered mobile wallets, particularly in Asia, and that was ultimately sold to Wirecard, which is another interesting story. And then since then, I've done a bit of investing in fintechs with a group of ex-bankers, and also these days I'm really just consulting in Asia, Middle East, and a bit in Europe to telcos, to retail banks, and some processes.
You look, Grant, it's really interesting that you talked about working with buy now, pay later companies in the 80s. Because one of the things, I guess, with the current iteration of buy now, pay later is what was this idea that this was this great new discovery and concept. But actually, I mean, I can remember as a kid buying things on lay-by in local shops. So it's not really something that was just new and emerged out of nowhere, was it?
Oh, no, definitely not. I mean, buy now, pay later has over 350-year history. There's even some proof that the Greeks and the Romans used it. In the US, for example, Singer pioneered its development of sewing machines in the 1850s using buy now, pay later. You had a fight in the 1920s between Ford and General Motors. General Motors was pioneering buy now, pay later. Henry Ford had to sort of cave in and join the party. You had a US company called Certegy came and set up in Australia in 1989. They rolled out a thing called Easy Credit, which is installments and buy now, pay later. So it's been around at all sorts of iterations. I mean, one of the products I used when I was at NZI Bank was a global airline product called Fly Now, Pay Later, which gave you 12 months free credit, 3, 6, 9 or 12 months to pay off your airline installments. Now, that all went west when funding rates took off in the 80s. And also new technology came along, which was getting rid of paper. So the same threats are around today. These apps really evolved out of a Swedish company and a Dutch company. Klarna was established in 2005, and then a company called Afterpay Holland was established in 2005 as well. So these things have been around for a while. The difference is putting an app on a phone is a new twist on an old idea, is how I would describe it.
Yeah, so I guess the contemporary iteration of buy now, pay later is the app. It's the technology side of it. But indeed the concept is not new. So you've obviously got a a lot of knowledge of the background of it all. I guess when the hype really started to emerge, I guess we're talking now, I don't know, 5 or 6 years ago, perhaps, roughly. What were you thinking when that hype started to really kick in?
Oh, that it would be a boom bust scenario, because you can't get away from the basics of a product where if you offer a consumer $100 and they pay $25 up front, but they have to pay the other $75 off in 3 installments, that's a loan, whichever way you cut it. The fact that these apps were able to get around, have loopholes in various countries, or just ignore the law, didn't really help them in the long term, because they're really unregulated credit. The other problem is these apps were taking enormous risks on credit. In other words, they were not checking customers, or they were claiming to have very fancy tools that enabled them to check customers. But if you did the basic maths on their losses, the losses were just horrendous. So that's fine when interest rates are very low, but the moment interest rates go up, you're in trouble.
So
one of
the things that we've heard about buy now, pay later a lot in recent years is that it appeals to millennials and Generation Z because they can buy things without paying interest and fees, and they're not as interested in credit cards as perhaps older generations. But you make the point there that, I mean, effectively it's unregulated credit. It's really interesting to me that they have been able to sort of spin themselves as not being lenders. I mean, how's that been possible?
Well, if you're unregulated, you're not accountable to anybody. The only people you're accountable to is the stock market and stockbrokers, and who would want to be regulated by them, because they're only after making a buck. So that's all they have to worry about. And if you look at players like Afterpay and Zip, they have government relation departments and PR departments that rival the political parties. So they know what they're doing. They've been playing this game of, we need to stay unregulated for as long as possible. And they've simply been quite methodical in how they've gone about lobbying politicians, lobbying regulators. In Australia, for example, they have employed a number of ex-regulators who've jumped the fence and gone and joined them. So that, again, is, to me, just more evidence of their desire to stay out of the regulatory trap, as they see it, and remain unregulated, where you don't have to worry about complying with all these rules.
That's really interesting. So the lobbying and the marketing and I guess the PR spin has been in overdrive in the last few years. But things are catching up with them now, because obviously both over there in Australia and here in New Zealand, the governments are moving to regulate the buy now, pay later sector. I just wonder though, like, given the way the sector's going at the moment, is there going to be much left once these regulations come in?
There might not be much left to regulate, that's right. If you look at there are 32 players in Australia and New Zealand who are promoting buy now, pay later apps. There are another 26 copycats who are in other sectors, such as providing cash advance loans or short-term lending, again, trying to use this lending niche to promote their products. Now, people tend to focus on what the listed stocks on the Australian Stock Exchange are doing. A number of them have been sold or cancelled. One's gone bust. Several have delisted. The problem with that is that only represents part of the market. So I think regulation is still required, because you need to clean this whole sector out and get all the players to adhere to basically lending regulation, because it's a real myth that there is no consumer harm here. There's plenty of evidence that young consumers, 40% of buy now, pay later users in Australia and New Zealand earn less than $40,000. Now, it's pretty easy to get into trouble if you're earning that small amount of money, and you've got 4 or 5 buy now, pay later apps going, and you're buying groceries. That says you're in trouble.
And I guess as well, there's an impact on your personal credit rating potentially, isn't there?
There can be, yes. And again, the line from the industry is, we don't sue individuals, but they do sell debt to debt collectors who do pursue the individual. So whilst the fintech company may not pursue you and may not take you to court, sure as hell debt collectors do. So that's another myth that, again, is sort of propagated around. It's all part of this I guess this folksy line of spin they put out that, we're here to help, we're here to make life enjoyable, life's fun. What's $100, that you're using, which is it's about $135 is the average ticket size. But the point is, most of these young people have 7, 8, 9 accounts. So it's not $100; it's $7, 8, $900 a month, and they have to pay it back.
Yeah, absolutely. I mean, we saw some figures here from credit bureau Centrix last week saying that buy now, pay later arrears have reached their highest level to date of 9.3%, which is similar to what we're seeing in unsecured personal loans now. So that's pretty interesting. And I mean, obviously, both in Australia and New Zealand, we've got a high inflation environment, rising interest rates. So, I mean, potentially things could get pretty bad here, couldn't they?
Oh, absolutely. And they're already starting off from a very high mark. The thing that the buy now, pay later apps do is they use a different comparison to look at bad debts. They compare bad debts to sales. So as opposed to a bank that would compare bad debts to receivables, which is the amount owing. Now, again, why is this problematic? If, you take the $100 sale example, $25 has to be paid up front. So the loan is actually $75. So if you're comparing sales to bad debts, you've already got a 25% discount because that's already paid up front. The second issue is with buy now, pay later, it's essentially an online product, and returns are very high. They can be anywhere up to 30 to 35% of consumers sending goods back and wanting credits. Again, that's erroneous to have that number still in any comparison with bad debts. If you do compare Afterpay with its bad debts to receivables, they're running at 13% of receivables. The Commonwealth Bank in Australia is running at 25 basis points on its credit card portfolio at the moment. So 13% versus 1/4 of 1%. That's the comparison. So you can see how much these people drive debt. In fact, I think they're actually worse than payday lenders in terms of what they're doing, but they do it with an image that doesn't actually hold scrutiny.
I'm interested in the timing of, I guess, the problems that the companies are facing now. I mean, just in recent months, we've seen OpenPay obviously go into receivership. Lay-by has delisted from the Australian Stock Exchange. Hum has pulled out of the New Zealand market. And just the other day, Latitude Financial Services announced that it was pulling the plug on its buy now, pay later services, Genoa Pay and Latitude Pay. Why is this happening now? What is there anything significant about the timing?
Yeah, it's all about funding. I mean, there is no such thing as free lunch. If you're giving a consumer $100 and it's free, quote unquote, somebody is paying for that, and you have to borrow money to fund that debt. And the buy now, pay later apps are funding that gap because they have to pay the merchant $96 at the point of purchase when the goods are bought. They then have to collect the money from the consumer. They have to fund the gap from 0 to 52 days, which is when the last installments plus any bad debts they have. Now, funding rates have gone up. If you go back 18 months, they were paying less than 1%. Today, they're paying between 5.5% and 18% money in terms of the cost of money to borrow. So that if you just look at their profit and losses, it's now one of their biggest expenses is in fact funding. It's also driving them to increase prices. I mean, the prices they're charging to merchants and to consumers are going up enormously.
So, I mean, the rising interest rate environment is obviously a key factor here in their struggles right now. I mean, is it a sustainable business model? I mean, if you look at the revenue, so late fees and then obviously merchant service fees that they charge to the retailers who use their buy now, pay later service are the key revenue streams. And I mean, in New Zealand, we've just moved to having banks' merchant service fees regulated by the Commerce Commission. Buy now, pay later ones are not currently being regulated, but the Commerce Commission is looking at them. So, I mean, is this a sustainable business model, revenue model, and are there other revenue sources they can maybe tap into?
Well, I think there's a couple of things here. That there are there are actually 7 different models of buy now pay later around the world. The fintech app is just one of those. So there are a whole lot of other sustainable models around which don't have anywhere near the credit risks. They also don't have the same structure as these fintechs. For example, many banks around the world simply use buy now pay later within their own customer base. So they don't have high acquisition costs. They also have very low credit losses. So they can run these businesses in terms of making a contribution across their consumer bases. If you listen to the spin 7 years ago, they were going to dominate all banks. Banks were going to disappear off the planet. These guys were going to come and clean everybody's clock. Well, no payment niche has ever come along and expanded beyond its norm. If you look at buy now pay later in 2021 globally, these apps are only in 3 of the top 10 online markets. That's the US, UK, and Germany. They're not in China, they're not in Japan, they're not in Korea, and they've got no chance of getting into those markets. If you look at their spending in 2021, it was US dollars 778 billion globally was spent on Pay on 4. That's 14 basis points of the whole online market. So how's that ever going to clean every bank out of existence if you can only get after 2005 to 2023, you've got 14 basis points of online sales.
So you talked about how they wouldn't get into other big markets such as China. Why do you say that?
Well, because Alipay and WeChat have already had installments since 2017 and 18. They've got 2.4 billion wallets in China, mobile wallets. If you think you can go and crack that market as little old Afterpay or little old Klarna or whatever, you are dreaming. In fact, they are realistic. They never talk about those markets. They never talk about Korea, which is the 8th biggest online market in the world, Japan, which is the 4th biggest. Again, they've all got installment products. They've had them for years.
So what do you think is the future for the fintech app version of buy now pay later?
I think it's very dismal. I think unless they can be bought by somebody, most of them will have disappeared by the end of this year.
So
they're all in trouble. They're all in deep trouble.
So when the Afterpay deal happened in 2021, so I mentioned Square, now known as Block, came up with this $29 billion US all stock acquisition. Was that the high watermark? And what were your thoughts at the time?
I thought it was a crazy price, and I said so. Even half that was still crazy, because and that's been borne out. If you look at Afterpay today, it's 6% of Block's revenue. So to pay, and their price in their books for Afterpay is $13.8 billion. Now their whole market cap today is $44 billion. So you can't make any sense of that as a good acquisition. And the other problem is Afterpay customers are entirely different from the other Block customers. You look at, Block has a big crypto portfolio, which is all crypto bros. You have buy now pay later, which is essentially young women, and then you have the biggest business is the Cash App business, which you can send. And it's a US thing where you send each other cash over this app, and because of the fragmented banking market, it works there. It doesn't work anywhere else. The other business they have is merchant acquiring, which is about a third of their revenue.
Yeah, we talk about buy now, pay later as you just mentioned there, most of their customers being young women, and I guess buying low-priced goods and services. There has been some sort of, I guess, talk at least, or moves by some of the companies to try and move into higher-priced goods and, I guess, wealthier clientele. Any scope for them in doing that to I guess, build a more sustainable business model?
Well, you can try and do that. But one of the things that Buy Now Pay Later has done is actually given American Express and Diners Club and JCB and all the charge cards a huge kick. Because if you look at consumers have woken up to the fact that you can use a charge card, which enables you to have a month's free credit. You have to pay the full balance back at the end of the month. You can't roll it over like a credit card. And if you look at Amex's volume, it's up 19% for the last quarter. It's up 32% last year. So what they've done, in fact, if they go and try and battle on that turf, you've got a whole lot of different issues as to how you look after high net worth customers, and that usually isn't about repaying something every 14 days.
Now, there have been a lot of people very excited about the fintech app version of Buy Now, Pay Later in recent years. And I mean, I look here at a Bernstein analyst report that I saw back in 2021 and saying that Buy Now, Pay Later services may evolve into an open loop rather than closed loop offering, replacing banks as the dominant card issuers of the future for Visa and MasterCard. And I guess, I mean, you know what open loop is, but just for the listeners who may not, an open loop card is a general purpose charge card that can be used anywhere that brand of card is accepted, versus a closed loop card as an electronic payment card that a cardholder can only use to make purchases from a single company. So, I mean, why did people get so excited? And is that sort of example something you think is feasible?
Well, no, it's not feasible at all, and I think it's the old story of a little knowledge is a dangerous thing. I don't think that analyst understands cards, because Buy Now, Pay Later depend on Visa and MasterCard. I mean, 85% of all transactions are debit, Visa and MasterCard, and they actually live off the interchange that creates. The about 12% of credit card transactions, again, which are Visa and MasterCard, the predominant use. So they are well and truly hooked into the Visa and MasterCard world. And if they had to get rid of it, for example, the big threat to Buy Now, Pay Later is in fact real-time payments, where if you can construct a complete network which would rival Visa and MasterCard and have very low interchange, that you could run Buy Now, Pay Later on that network. It's much faster, much more efficient, much lower cost. The problem is you have to be able to set up and fund it and grow a business based on those economics.
So you're saying that you can imagine, or you anticipate that a lot of these Buy Now, Pay Now companies will be gone as soon as the end of the year. So, I mean, what do you think will be left?
Well, I think that you've already got incumbent players, and particularly you've got Apple that's already coming to play as well. I mean, PayPal already now says it's the largest Buy Now, Pay Later player in the world. They've got 550 million customers. I mean, Apple has over 600 million wallets around the world. It can roll out Buy Now, Pay Later. It's going to be doing it in the US later this year. So it will come to Australia and New Zealand pretty quickly, because this is a key market. And again, you have to question, if Australia and New Zealand are a key market in any global trend, that's not really sustainable, is it?
It's not a big part of the global market, is it?
Well, no. I mean, we have our place. I mean, but we're not going to be. We're never going to win a critical mass argument, in terms of 30-odd million at this part of the world.
No. Look, I mean, the picture you paint here is very much of, I guess, the latest sort of version of the big bubble and bust that we see in I guess, certainly on the share market side of this, and a hot new, or what appeared to be a hot new idea that actually maybe there was a lot of smoke and mirrors behind it. So I'm just wondering, what do you see as the lessons from this episode of the fintech app, Buy Now, Pay Later?
I think it's the same lesson that people should learn out of crypto. It's also the same lesson you can learn out of SPACs in America, which were these special purpose vehicles which were pumped up and sold. I mean, this sort of activity of pumping up a niche or pumping up a product set has been around since humanity started. So this is not something that's just a euphemism for now. I think the issue was that the fundamentals of the size of this marketplace, the economics of it, were ignored, and they were ignored to the detriment of simply spinning a story which people got carried away with, and the hype was self-generating. And if you look at the people involved in that, it's like any boom. I mean, I remember the gold boom. I was living in England in the late 70s, and gold just shot up, and half of Bond Street was gold bullion dealers. You could walk in there and you could buy a gold bar and you could go and look at it, come back the next day and have a look at it again. And of course, that's a classic. Within 18 months, it was all gone. I mean, that was driven by, again, supposedly an inflation hedge. You go back to the Dutch tulip boom. You go back to the American railways boom. I mean, all these things, people made and lost fortunes on sort of railway stocks. These things have been around for eternity. The point is, what do you spot as a real trend, like smartphones, which have driven enormous value, versus buy now pay later, which is always only ever a small niche. How is a small niche suddenly going to take over a whole industry? Now, this is in some ways the whole fintech narrative is a little bit around this. If you look at fintech as a category, it's only been around since 2008. It's been driven by venture capitalists and their investors, and they've got a pretty sinister game plan here of trying to drive these things to market, get paid, and then leave. That's their game plan. And if you look at neobanks, it's been the same. If you look at buy now, pay later, it's been the same. Look at a number of other sectors in the so-called fintech. Crypto is a classic. I mean, crypto got to over 3.5 trillion. Today, it's a third of that. And crypto has got no utility in payments whatsoever. I mean, if you look at the daily volume on Bitcoin, it's 350,000 transactions a day. Now, that a major bank does more than that. So how can you blow that up? And it takes 7 minutes to clear a transaction. So you then say, how's this going to work in the payments environment? If you're standing, if you're at a restaurant this afternoon, are you going to wait 7 minutes to get your bill paid? To make sure, if you're using Bitcoin in a restaurant? No, most people just walk out. They've gone. So you've got to explore these fundamentals and say, what is the likelihood of success? And in my view, it was very low. And I wrote something in 2017, which was part of a submission to the Productivity Commission in Australia. It's basically saying that. And people sort of poo-pooed me and said, oh, you're just negative, But truth comes to part in terms of looking at fundamentals of an industry, of a sector, of a product, and you can't ignore those.
Well, look, Grant, it's a really interesting rundown on where things have gone wrong with the buy now, pay later fintech app version, we'll call it. And look, appreciate your time. That is Grant Halverson, who is the CEO of McLean Roach, and I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.